Good afternoon, everyone. Welcome back to the 18th of November weekly market review. So today I have with me, as usual, Mr. Gerald Wong. How are you, Gerald?
Hi, Sunny. Good. I guess we are getting close to the end of the year, but at the same time, we are still seeing quite significant moves in the market. So hope to be able to go through with the participants with us today.
Yes, I see some of the Christmas decorations on our malls coming up already. And last week on the US side, we had a bit of a pullback, which to me signifies the end of the post-election rally. And of course, on Thursday, we have Fed Chair Jerome Powell comments to say that, hey, we may not be cutting interest rate as fast as we expected earlier because of strong economic data. So I believe you will go through some of the CPI data today, as well as the Singapore earnings of some of the major companies.
That's right. As usual, today's sharing is for information purposes only and should not be taken to be financial advice. We have an upcoming Ask SIAS this Wednesday, 20th of November. So if you would like to ask Sunny and myself questions relating to some of our recent updates, some of the outlook for 2025, as well as to understand the recently launched Hong Kong Singapore depository receipts in more detail, do join the webinar where you'll be able to ask these questions to both Sunny and myself. If you find the weekly market review helpful, do leave us a review on Google. And if you're wondering how you can join SIAS as a member, you can go to the site sias.org.sg/membership or scan this QR code. And as a SIAS member, you'll be able to access various online resources as well as investor education programs. Okay, so Sunny mentioned the pullback in the US market last week. We saw the S&P 500 coming down from close to the 6,000 level to 5,871 points on Friday, representing a 2.1% decline. As we can see from this chart, the losses were led mainly by the tech stocks, where we saw that the Nasdaq was down by 3.1% in the past week. Okay, for those investors who have got positions in the Singapore market, the good news is that the STI actually bucked the downward trend in the US market with a 0.6% gain in the past week. We'll go through some of these reasons behind the gains in the Singapore market later on. Okay, there were a few key economic developments in the US in the past week. First and foremost, we have the announcement of the inflation data for October. This will represent the growth in the core CPI on a month-on-month basis. And what we see here is that it increased 0.3% compared to the previous month. This is broadly in line with expectations. And what we see here is that for the past 3 months, it has been stabilizing at about the 0.3% month-on-month increase level. Okay, so this wasn't the big news that drove the market. But as Sunny mentioned earlier, we had comments by the US Federal Reserve Chairman that they are not in a hurry to be cutting interest rates because the economic data in the US remains fairly strong. And with the comments by the Federal Reserve Chairman, we actually saw that the US government bond yields continued to increase. Okay, so we can see here the 10-year US government bond yield actually back to the highs in July this year at about 4.5%. At one point last week, it exceeded the 4.5% level before coming down slightly on Friday to end the week at 4.46%. Okay, so what we see from this chart is that there was this decline in anticipation of the Fed rate cut in September. The 10-year government bond yield went down to as low as 3.6%. But since then, because the economic data has been fairly strong, we have seen the US 10-year government bond yield rebounding to the 4.5% level. So quite a significant move within the span of a few months. Okay, and if we're to look at the latest expectations of the interest rate cuts by the US Federal Reserve, we have seen a moderation in expectations. While there is still one rate cut expected in December, we have seen the probability of that coming down over the past few weeks. But if you're to look at the expectations on 2025 rate cuts, if you've been following our weekly market review, I think at some point in time, there were as many as 6 rate cuts expected in 2025. But when I was updating the chart yesterday, what we see is that effectively we might just be looking at potentially 2 further rate cuts in 2025, which will bring the US Federal Reserve target rate to 3.75% to 4%, from potentially 4.25 to 4.5% in December. Okay, so I shared earlier that the expectations of the rate cuts have moderated. We can also compare the probability of a rate cut in December. If I was to look at it 1 month ago, okay, it was more than 70% probability that we will see a rate cut in December. But following the strong US economic data, following the election of Donald Trump as the next US president, following the comments by Jerome Powell, we see that the probability of a December rate cut has come down to just above 60%. Okay, so how has that been reflected in the Singapore market? We saw that the STI outperformed the US market last week, and a big part of it was driven by gains in the Singapore banks. We see continued strength in the Singapore banks, with OCBC and UOB leading the top performers of the STI. Okay, on the other hand, in terms of the worst performers, we have a number of names that reported their results last week, including Venture Corp, Singtel, actually having losses in the past week, and likewise Seatrium with a 7% loss in the past week. Okay, if you to look at the performance of the US REITs, they have also come down with the increase in the US government bond yields, and we see that the REITs with US office assets have been more significantly hit given the sharp increase that we see in US government bond yields. On the other hand, we see that some of the REITs with data center assets actually outperforming, given that we have got some of these REITs reporting fairly decent earnings in the most recent operational updates. Okay, so I'll go through 2 names today. The first is Singapore Airlines, and then the next is Singtel, both of which are blue chip names that I'm sure many investors actually follow. Okay, so for SIA, we saw them releasing the earnings, and there was a decline in the share price thereafter, hitting a low of close to $6.20, before recovering slightly to $6.33. Okay, so this is a summary of the earnings. If I can just walk you through the second quarter earnings, which is what is shown in the few columns on the right. While the revenue was still growing at 2% compared to the previous year, we saw a very sharp spike in expenditure. It was 14.7% higher compared to the previous year. And with that, we saw the operating profit of SIA coming down by 59% compared to the previous year, and net profit down by 59% also compared to the previous year. So this was below the market expectations, probably not expecting such a sharp decline in profit, which actually led to the weakness in SIA share price. Okay, so I mentioned earlier that it was still able to report a slight increase in revenue. And if it's to break it down by whether is it driven by the passenger flown revenue or the cargo revenue, then what we see here is that the cargo revenue was still growing compared to the previous year. It actually grew 8.3% compared to the previous year, but because the cargo revenue is smaller percentage of SIA's group revenue compared to the passenger flown revenue, when we saw this 1% year-on-year decline in passenger flown revenue, it was actually a drag to the overall group revenue growth, such that we only saw a 2% increase compared to the previous year. Okay, so we'll dive deeper as to what is driving this decline in SIA's group revenue for the passenger flown revenue. And what we see here is that in terms of the load factor, it actually came down. So what this represents is that while there's been an increase in the number of passengers that it has flown, because it has increased its capacity more than the demand, the load factor actually came down to 85.8% in the second quarter of the fiscal year 2425, which is the quarter ending September 2024. And if it's to compare that to the previous year, it was actually at 88.6%. Okay. In terms of how much it's able to earn from each passenger, we also see that it has actually come down, and this represents a compression of the yield, which also led to a decline in the revenue of SIA's passenger flown revenue. Okay, so this was something that the CEO of SIA highlighted. If you were to look at the full service carrier yield, it has been under pressure. If you were to look at the first quarter of the latest fiscal year and the second quarter, in the first quarter, it declined by 5.8% compared to the previous year. And in the second quarter, it declined by 9% compared to the previous year. Okay, so as the post-COVID recovery starts to level off, as well as increased competition from other carriers, we have seen this yield pressure coming through for the full service carrier. Okay, and then with the revenue not growing much and the expenditure actually growing fairly sharply, that actually led to the decline in SIA's operating profit. So we see here that in the second quarter, the group expenditure increased by 15%. We saw that there was an increase in both the fuel costs as well as the non-fuel expenditure, and that reflects some of the cost pressure that SIA is currently facing. Okay, so I mentioned earlier, the group operating profit was actually down 59% compared to the previous year. And we can see a very clear trend here in that the group operating profit on a quarterly basis peaked at the second quarter of last fiscal year. And it has been on a slowly declining trend over the past few quarters. Okay, the good news from a dividend perspective is that despite the fall in the earnings per share, SIA has actually maintained its interim dividend at 10 cents. Okay, so that is unchanged compared to the previous year. Okay, so given that the share price has come off sharply, it has actually maintained the interim dividend, and likewise, analysts are forecasting that it will actually maintain its final dividend for this fiscal year. So with that, we are looking at a fairly attractive dividend of SIA if it is able to maintain its dividends per share. And then if you to look at the price to book perspective, it is now trading at 1.4 times price to book. Okay, next I will mention Singtel, which reported its earnings in the past week. Singtel shares has actually went up quite sharply since May this year, reaching close to $3.40 at the 52-week high, before coming down more recently to about $3.16 as of last Friday's close. Okay, so this is a summary and snapshot of Singtel's most recent earnings. We see that the operating revenue was fairly stable. And then on a underlying net profit basis, it was actually up 6% year on year. And if there were no currency impact, it would have actually been up 9% year on year. Okay, on a headline net profit basis, you see a fairly sharp decline in the reported net profit, and that was because they had the exceptional gain of 1.2 billion in the same period last year. Okay, if we're to break down the performance of some of the key businesses, what we see here is earlier I mentioned the revenue was stable compared to the previous year, and that is what we see for the Australian business, Optus, as well as Singapore business. So what was actually more of a surprise to the market was that the Australian business actually saw a sharp increase in the operating profit. And that was something that was attributed to the better mobile performance, as well as the improvement in the margins for the enterprise business. Okay, if it's to look at some of the growth businesses, I've been talking about how Singtel is positioning for growth through NCS as well as the digital infraco. And what we see here is that particularly for NCS, there was actually a sharp increase in the operating profit, driven by this growth in the revenue increase with the digitalization demand, as well as improved margins due to the better delivery, as well as some of the cost cutting, as well as optimization. Okay, in terms of the performance of the regional associates, that is something that has then got more mixed performance. Particularly, there was a drag to the earnings because of the strength of the Sing dollar relative to some of these regional businesses. Okay, so if it's to look at where some of these weaknesses actually are, we see that in Telkomsel, as well as in the performance of Airtel. Okay, so for Telkomsel, it was impacted by intense mobile data competition. And then for Airtel, there was lower contribution due to some of the costs, including interest as well as dividend tax. Okay, once again, what we see as a more positive sign for Singtel is the increase in the dividends. So in total, the interim dividend was 7 cents, and that includes a core dividend of 5.6 cents, as well as a value realization dividend of 1.4 cents. So if you recall what Singtel has committed in terms of the dividends, because of some of the capital recycling initiatives that it has taken on, that is reflected in the value realization dividend, where it hopes to be able to distribute some of these gains to shareholders, and that is being reflected in the increase in interim dividend that we see. Okay, in terms of the outlook that it has given for this fiscal year, effectively, it has narrowed the EBIT growth rate outlook from previously high single digit to low double digit to now being able to affirm that it will probably end up in the low double digit range. So what we have seen for the first half of this year is that it has already been able to grow the EBIT at 27%. Okay, in terms of the cost savings, it believes it is on track to realizing that. Regional associates dividends also on track, as the value realization dividend, it had previously committed to 3 to 6 cents per share. And as I mentioned earlier, in the interim, it has actually announced a 1.4 cents value realization dividend. Okay, so in terms of what to look out for this coming week, we have the EGM for CapitaLand Escort Trust that is happening today, 18th of November, where unit holders will vote on the acquisition of Life Funan. Okay, we have a SGX Discovery series where we will have the management of the 3 European S-REITs listed in Singapore that will share more about their company performance as well as outlook. So if you are interested to understand more about this European S-REITs, do join the webinar that's happening on 19th of November. I mentioned earlier that we have the SIAS on 20th of November, and then going to Thursday, we have the 6-month Singapore T-bill auction, as well as the widely anticipated NVIDIA earnings. Okay, so with that, I'll hand over to Sunny, who will share with us the technical analysis.
Okay, thanks, Gerald, for that insightful sharing on SIA and Singtel. And I believe, I guarantee plus chop that he will share the NVIDIA earnings next week. So do look forward to that. Okay, that was on Thursday this week that we will see the earnings results. And on next Monday, we would maybe have a review of that. Okay, so let me try to gel up or sum up all the stories or what happened last week on the indices. I'll start with the Singapore index. So in the early part of November, we can see that the bank's earnings actually pushed up the STI index to a year-to-date high or a multi-year high at the high of 3,760 points. And last week, last Monday, I said that okay, we have reached the resistance level already because the STI has already breached the upper bound of the Bollinger Band, which in technical terms or in statistical terms, the usage of the Bollinger Band says that 90% of the time with the prices of the counter or the index usually trade within that Bollinger Band. So we actually have a breach of that happening, and then we are seeing some resistance or some sort of a slowdown in the uptrend that we observed in the beginning of November. So the push up in the STI index in the early part of November, of course, led by the wonderful local banks earnings that forms up a major part of the STI index. And last week, we heard the news on US that the interest rate cuts going forward may not be as what we have earlier predicted, as what Gerald go through, that we may not have as many rate cuts next year. So that is actually having a positive impact on the Singapore banks. As you have observed earlier part this year as well, when we are seeing that the rate cuts, we expect rate cuts to happen, and then Singapore bank actually pull back. But in the previous few years, when the interest rate were very high, the bank stocks actually perform very well due to the interest income that they can probably generate from there. So going forward, I think with one eye in 2025, the bank stocks are likely going to continue and do well. And next year, we will probably test the 3,900 level, which is the 2007 high that we saw, the all-time high. Okay. On the SCI index last week, we also saw some pullbacks on the REITs, which is also the impact of the expectation that rate cuts may not happen that much next year, and there may be less rate cuts next year. So the REITs that were looking forward to the rate cuts happening that could help them improve their margin suffered a pullback last week. Counters like CapitaLand, Ascendant Street, counters like US Prime REIT actually had quite a bit of a pullback last week as well. So that is holding back the STI from going higher than the year-to-date high at 3,760. So with the STI now testing that resistance since the Monday of last week, and with the indicators telling us that you can see the MACD indicator is still positive, it's still showing that there's positive momentum in the STI index. But you can see in the last few trading sessions, that positive momentum is starting to subside according to the MACD histogram. That green color bar is trying to fade into the background. Okay, so that means that the uptrend momentum is starting to slow down. The RSI has also hit above the 70-point mark. That means that it indicates the STI index is now overbought, and that concurs with what the Bollinger Band is saying. We are in the overbought level. We have traded out of the Bollinger Band. Hence, I would expect the STI to have a quite significant pullback towards at least the 20 days moving average, which is the black line that you see here, also known as the Bollinger Band basis, now at 3,642 points. Okay. And if we fall lower, the next support level will come in at the 50 days exponential moving average, which is the blue line that you see right here. And that is around the 3,598 points, or I'll round it off to the 3,600 level. Okay, so the 3,600 level will be a very important critical level that I will watch out for, because if I observe the STI in the past few months or this year, you can see that sometimes the 50 days moving average, the blue line that you see here, usually provide quite a bit of support for the STI index, especially when it starts to find confluence with the lower bound of the Bollinger Band, which is the black line that you see below over here. So the black line of the Bollinger Band now is closer to the 100 days exponential moving average in amber, and that is around the 3,500 points. I think that is a very good that is a no-brainer there. If STI were to go back to 3,500 level, that is definitely a buy. But you can see over here somewhere in the early part of November, where it hits the 50 days moving average, the STI index starts to rebound again. So for the STI index, as you have known, last week I mentioned I have sort of closed my portfolio this year, and I'm having starting to plan what kind of trades I'm going to put in next year. And for the SCI index, if it pulls back to the 50 days moving average at 3,600 level, that is where I will start to accumulate on the SCI index again, and I will stagger it towards the lower bound of the Bollinger Band around the 3,500 level. So this is the level over here. I will draw this this rectangle over here, where I will accumulate on the STI index between the 3,600 and the 3,500 points level. Okay. So next, let's move to the US indices. So the US indices, also the post-election rally, as I said earlier, has ended, and that ended on the full stop of what Jerome Powell said last Thursday, where he said that the extent of the rate cut is still to be determined by the data that he sees going forward. But he sees that the US economy's strong growth does not necessitate him to cut or project any interest rate cuts going forward. And with the inflation being sticky right now, as what we have went through earlier, interest rate is expected to maintain at around current levels for a even longer period of time, some of the analysts were saying. Okay, so the Dow Jones Index, of course, on that note, has a pullback already. We have breached the upper bound of that Bollinger Band, so that pullback is, of course, expected. The indicators-wise, the MACD, you can see that the slowdown in the momentum of the uptrend is also very significant, at least from the last 4 trading session. You can see that the MACD line starts to converge towards the signal line, and when a crossover happens from there, that could confirm that the downtrend is likely going to pull back further. So the Dow Jones is a 30 stocks index of some of the top 30 companies in the US. So it's a fairly resilient kind of index that I'm looking at. So you can see if it pulls back usually towards the 50 days moving average, you will start to see a rebound again. Of course, if you go to 100, then definitely there will be more support level coming in. So similar, looking at the Dow Jones Index, which is a similar 30 stocks STI index, the 50 days moving average will be a key important level that I'm looking at. If let's say it pullbacks to this level, I would definitely love to accumulate further at the 42,430 points level. That is where the 50 days exponential moving average is right now, with the Bollinger Band basis or the 20 days moving average now at 42,913 points. So round it off, I would say 43,000 or 42,500. Those are the key levels that you could be looking at to accumulate the Dow Jones Index with an eye of growth next year as well. Okay. So this is where I will accumulate on the Dow Jones Index. So don't have to FOMO, don't have to chase this rally that we observed in the early part of November. Don't have to worry that you are going to miss out on the Santa Claus rally that you are seeing. We will wait for the index to come back to us to a level that we see support coming in before we get back on the indices. Okay. Next, let's move to the broad index S&P 500. S&P 500, of course, tested the upper bound Bollinger Band, and we are now sitting right just above the Bollinger Band basis or the 20 days moving average at 5,860 points. Last Friday closing was 5,870 points. So I expect this pullback on the S&P 500 to continue. Of course, the NVIDIA data coming this Thursday would have a big impact on the S&P 500 index as well, but that is only one counter among the 500 companies. So on a going back to the fundamentals on a longer term basis, I expect the S&P 500 to pull back at least to the 50 days moving average, which is now at 5,779 points. As you can see over here, early part of November, we saw that bounce over happening also on the 50 days moving average. So I will be accumulating between the 50 days moving average and the 100 days moving average, and that is the zone that's around here. Okay, that's where you can get in to get into a good support level on the broad index of the S&P 500. The crossover of the MACD indicator will likely happen this week, and that would confirm the downtrend or the pullback that we are going to experience soon, and hence the 20 days moving average is likely unable to hold, and the next level of support we are going to test will be the 50 days moving average. The RSI is also swinging down quite steeply, so that means that the momentum is coming down quite significantly, and we are going to test the 50-point neutral mark on the RSI very soon, with the last Friday reading at 52. So if we cross below the 50-point mark, that means momentum is going to get extremely weak, and hence from there we would have to need to wait for the S&P 500 to go towards the oversold level, like what we saw during the August period, closer to the RSI 30 points level before we get into the S&P 500. So these are the indicators that you can sort of look at or reference to see what could be a good level to position yourself for next year growth on the broad index S&P 500, which is 5,779 points. That is the first level that I'm looking at. Okay, next let's move to the most volatile tech-focused, tech-heavy Nasdaq Composite Index. We have breached the 20 days moving average on the Nasdaq Composite Index. We closed below that 20 days moving average reading of 18,715 points. Last Friday closing was 18,680 points. So that is definitely signifies to us that, hey, it is below the short-term moving average of 20 days. So that is a negative sign for us. We also see that the MACD indicator would likely have a crossover happening this week, and that could confirm the downtrend that the Nasdaq Composite is likely to go through in the next few weeks. The RSI is right spot on the 50-point neutral mark on the RSI indicator right now. So that means that if it goes below 50 points, that means the weaker momentum will take over, and hence the Nasdaq Composite Index is expected to drop further. And the next support level, of course, the blue line here, that would be the 50 days moving average at 18,364 points, with the next support level coming in on the 100 days moving average, as well as the low bound of the Bollinger Band at 17,919 points. So to round off somewhere the average between the 50 days and the 100 days moving average, the 18,000 handle would be the key support level that the Nasdaq Composite Index is looking out for to have a rebound, and then from there it may have a continuation of the long-term uptrend that we have been observing. So this uptrend would likely continue towards next year with the strong economic data that we are experiencing. Of course, with the incoming Trump administration, there will be a lot of uncertainty. Hence, it would always be good to get yourself into a safer level or support level before going into a position on the major indices on or whether the US or the Singapore side. Okay, so these are the updates that I have for you on the charts. So anything else to add, Gerald?
Well, I think you've done a very comprehensive analysis of the charts for us. If there are specific names that you would like Sunny to be going through the technical analysis, do join our SIAS this Wednesday, 20th of November. And if you've got any questions relating to Hong Kong SDRs, relating to individual stocks that you'd like us to share more about, we look forward to seeing you at the Ask SIAS this Wednesday.
Yes, so do join us as a member and join us on our RCS, and we'll try to answer all your investment questions on Wednesday. So, and I think that is all the time that we have for today. So everyone have a good and safe trading week, and we'll see you again on next Monday, the next weekly market review. Goodbye.